Welcome to Beyond the Guidelines, the podcast that takes you past the listings, the programs, and all the polished sales talk to reveal the real people shaping today's real estate world. Here we uncover the personal stories, struggles, and wins that define each guest, giving you a fresh, human perspective on the business. At Creative First Mortgage, we're on a mission to help you see the person behind the professional, because real estate isn't just about the deals, it's about connection.
So I am super excited to talk to my next guest. I'm not only a client of his, but I've known him, gosh, probably over 10 years. He's a wealth manager at Nowland Associates. Super great guy. Please welcome to the show, Mr. Mike Schwallie. What's up, Mike?
Hey, buddy. How are you, man? Great to see you.
Doing
I appreciate the opportunity. Thank you for having me on. And I apologize to you and your viewers for the glare that we got going on here, but part of it. I put a new shine on it for today's talk. So,
well, hey, man, we appreciate that. Maybe I can let you borrow a little. I think mine's getting a little crazy here. But hey, before we get into it, because I know we want to talk about the infinite banking concept, and I know there's a lot of people that may not know how it works and what type of product it is. But listen, before we get into all that, why don't you tell everybody a little bit about yourself, who you are, and what kind of guy you are that I know.
Sure. That's great. Thank you. Mid-50s, dad, husband, Christian, love my family, spend a lot of time with them. I'm a golf nerd. I was up at 4 a.m. this morning watching the British Open, if that dates our podcast today. So, but yeah, it just was a business owner for about 15 years of my career. Went to school here. I'm a Yankee that moved south to play some sports in college, and then stuck around, met my wife, and been married coming up on 25 years. And then I have two daughters, both of which are now, we're going to be empty nesters this year, man, believe it or not. So got one in college, finishing up her senior year, and one going to be a freshman next year. So really exciting times for us in our life and a new chapter. So look forward to that. And we'll get into how I got into the wealth management world here shortly. So yeah, thanks for the opportunity, man.
Absolutely, man. So yeah, we just finished our our daughter just graduated. So we just got our pay raise. So our college tuition days are over, which is a good feeling.
I look forward to those days.
Yeah. All right, Mike. So here's the big question. What is the infinite banking concept? And like, just in simple terms, if you could try to break down for our audience what it is, go ahead.
Happy. So the infinite banking concept is a process. A lot of people, when they first hear about it, they hear about the product first. But what we discovered and what people need to understand, it's a process, and it's really the banking function of our lives. So the infinite banking in a simple term is we got to think about, how do banks make money? You know, you and I, we park money at the bank, and then when we need capital, sometimes, you know, more capital than we have on reserve, we become a customer of the bank. We deposit on one door, and we have to go in the other door to take a loan, get a HELOC, whatever it might be. And so when banks when they loan me capital, whose money are they using? Are they using their own money?
Nope.
No, they use they use deposits from their customers, and then they lend it out at a higher rate, right? We might be getting a point, 2 points, 3 points, but they're going to loan out at 7, 8, 9 points sometimes. So they're making a rate of return on our money. Well, there's a gentleman that by the name of R. Nelson Nash that you had the pleasure to meet before he graduated. And Nelson discovered in the mid-'80s a concept that he called infinite banking. And essentially, it's using a product, a cash valued, I should say, dividend paying high early cash value life insurance through a mutual carrier. You know, big term for a simple product. But what he discovered is you can take a traditional whole life product, flip it on its head, and design it for cash accumulation. That becomes the warehouse. That becomes the place in which we store cash. And I asked Jason, you know, why do we put money at the bank? What I usually hear, it's safe and it's liquid. That's really it. I mean, we don't typically, you know, today, where we sit today, you can get a decent rate of return. If I would have asked you that question 5 years ago, you know, you're getting point something, right? Yep. So the average over the last 30 years is about 1.1 in low interest bearing money market CDs, savings accounts, things like that. So traditionally, we don't get a high rate of return. With life insurance, we get a competitive rate of return, in most cases between 4 to 5%. Not bad for a savings account. And it is a savings vehicle. It's not an investment vehicle. And what I mean by that is also it is tax-free. The way that we structure these accounts, life insurance provides a tax-free solution. It also, for a lot of you real estate investors, is creditor protected. So I own properties. I have tenants. If one of those tenants slips and falls, they're going to come after me. Where are they going to come after me? After my liquid dollars in those cases, right? My savings dollars. Well, this puts a barrier. It's privatized, and they can't attach a lien against this money. And then the final one, and one of the most kind of like what I say, the straw that stirs the drink, is the uninterrupted compounding. And we're going to get into that more later on this podcast, but you get to, your money never stops compounding day after day after a day, even when we access the dollars. So I know that wasn't a simple explanation, but hopefully that was a quick enough one to give you
I think you broke it down well. And it is, they call it infinite for a reason, because there's really so many ways that you can use it. And you've taught me over the years, where I can park my money, even if it's just an extra way to put, where I put my money. So like if I want to buy, a mutual fund, for example, instead of taking it out of my savings account and just dumping it into a mutual fund, I can run it through the policy. And we could talk about the opportunity cost that allows you to do, because once you take that money out of your savings account, you're losing that interest forever. However, if you're running it through a policy and then borrowing against it, that's essentially how you become your own bank. And I think that's really the important part of this program. So you did mention real estate as you were explaining it. And, most of our audience are real estate professionals, whether they be in mortgage, whether they be real estate or real estate investors. So maybe let's touch on how someone that's investing in real estate can use this product specifically.
Yeah, that's great. And I work with a ton of real estate investors, so I'm very familiar with what, whether it's buy and holds or rentals or fix and flips, or, if they're doing syndication deals, whatever it might be. What I usually tell them is, in any real estate transaction, it's usually an or transaction when we're talking about the capital. Now, everybody in real estate understands leverage is their friend, right? And so most real estate transactions, you're trying to leverage your dollar. You're trying to either buy an asset, appreciate it, borrow against it, buy another asset, rinse, recycle, and repeat, right? Well, the infinite banking concept, in what we like to call, is an and asset. Like you just mentioned, you don't have to give up the opportunity cost of your dollar. In a savings account, when you take money out, whether it's for a renovation or a down payment, you remove that money from its earnings potential to go put it. You had to make an or decision. Do I want to leave it in my savings account or put it in this real estate deal? Well, of course, you're going to put it in the real estate deal because you're going to get a higher rate of return. That's the game. Well, within infinite banking, if we use it as our warehouse for capital, when we take the money out, it's working inside and it can work externally to go get that same rate of return. We're not giving up that opportunity cost and that flow of money. So we've got two assets working at us simultaneously, if that makes sense. So that's the biggest benefit we see. Now, the second biggest benefit is the loan provisions. When you take money out of your savings account, Jason, who forces you to put money back in?
The bank.
Well, no, you do, right? I mean, the bank, they want you to put it back in. When you take it out of your savings account,
savings. I'm sorry. I thought you said when you borrowed. I'm sorry.
Sorry, not to borrow. Yeah, but when you just remove capital from your savings account, you force yourself to put it back in.
Right.
The alternative is, if you borrow, they force you to put it back in. Well, with infinite banking, you are in total control of the banking function. And so when it's just like your savings account, if I remove 50,000 out of my account, I go put it to work somewhere. When it returns with friends, I get to choose if I put it back in, right? And so that's the mindset, is the control factor as well. It's a big, because we don't know when money's flowing. Sometimes it is a fix and flip that takes 6 months or 9 months or a year or more, or it might be a syndication deal where it's out working for 3 to 4 or 5 years. Those dollars do not have to be returned inside the system. The insurance companies do not care if that money is loaned out. And I'll tell you why. The best analogy I can give you, Jason, and I might be jumping ahead here, it might be one of your questions, but the best analogy I can give is a home. We own homes, and let's say your home is fully paid off and it's $1 million home, and I live right next to you and it's the identical home and it's fully leveraged, right? Mm-hmm. Would you agree that both of our homes are worth $1 million?
Absolutely.
Yeah. So you could go but if you wanted to, you could go use equity from your home and borrow against it to go invest that dollar somewhere else. And you've done that, and I've done that, and a lot of people do. When you do that, does the value of your home go down?
Never.
No.
Your equity reduces, right? So if you ever wanted to sell your house, but your value always stays whatever the value of the home is.
Hopefully appreciating, right? That's not guaranteed. Now the life insurance, we'll see. Hopefully it is, right? We put ourselves in a good neighborhood, good place, and all that stuff.
Right.
But with life insurance, it works the same way. We build equity, we build cash value into a policy. When we want to borrow against it, it's as simple as a text or a phone call. Hey, I need XYZ amount of money. It goes out to you, but the cash value does not depreciate. It does not go down. Your equity, your availability to cash goes down, but your principal balance is continuing to contractually grow each and every year.
Yeah.
It never goes down. So that's the big benefit here.
Yeah, that's an incredible example. So that makes a lot of sense, especially for my real estate friends out there. So maybe let's take like a real world example. Let's say for my real estate investors out there, let's say that they want to go buy, a $200,000 rental and they want to borrow, 20% or $40,000, and they have money in one of these accounts, one of these life policies. So kind of walk through, like, what does that look like versus not using that policy at all? What would be the main benefit of using you to do that?
And I could probably, I don't want to give any of my clients examples away because they might be watching, but I'm going to use my real life example, my personal example. My wife was a speech pathologist. That's kind of our running joke because I have a lisp, but she's been a speech pathologist for over 25 years. And one of her coworkers came into the teacher's lounge and said, "Oh, hey, our daughter's graduating from Auburn and we've got to sell her condo." And she just spilled the beans, how much they paid for it, how much they want to sell for it. When my wife came home and told me the story, I immediately went online and looked it up, and the prices were selling for about $40,000, $50,000 more than what they're looking for, because they saw it as an expense. They saw it as, we're paying for our daughter to go to school. Yeah, she had a roommate, but it didn't even cover the mortgage every month. They just wanted to get out from underneath this property, right? I looked it up, looked like a great opportunity. I had number one, speed. I called the husband and I said, I can get you money by the end of the week. I didn't have to go ask for permission from a bank, right? It was $157,500. That's what I wrote the check for. I borrowed it from my policy, immediately hit my bank account. It takes about 48 hours, as you know. So it hits my account. We closed within about 10 days. It didn't quite, we took a little while for the closing attorney to draw everything up, but we were done. It was a quick action, boom, I'm in. Now, I put a tenant in that immediately. I live in the Birmingham area. I know a lot of people that go to Chelsea. I get to be selective on who my tenants are. I've got a pretty good pool of people that go down there every year that I know. And so I've got a great tenant in there now. It's $2,400 a month of income that's coming in. Where does that income go? If I need some of it, I keep some of it if I wanted to. Right now, luckily, I'm blessed and I don't need any of that income. So every dollar of that is going right back into my policy. But here's the thing. I've, got almost double that amount of cash value working inside my policy. When I borrowed that 150, I don't have access to that 150 right now, but my 300 is still growing and appreciating. I've done the math on it, Jason. It's going to take me about 7.5 years with that cash flow to fill back up my bucket. During that 7.5 years, my policy is going to grow contractually $188,000 tax-free. Okay.
So let me stop you there. So what you're saying is, so the money you're getting monthly, so you took that 157, you took it out of your policy.
Yep.
The monthly rent amount that you're getting, you're replacing that money back into your policy. And you're saying you'll get all that money back in 7.5 years while it's still earning interest on that full amount.
Yep.
Okay. So I just want everybody to hear that. And the other thing I didn't want to gloss over that you mentioned is you needed that money. You got that money in 48 hours. Guys, we're talking about no income qualification, no credit score needed. There is no repayment term obligation. This is your money to use. So I just want to be clear on that because you kind of glossed over that, but that's for a mortgage guy. That's really important for other people to hear.
And I'll even go a step further. Right now, my daughter is getting her master's up in Tennessee, and she plays basketball in college. She's going to be a grad player, but they covered her tuition and they covered her food, but they didn't cover her board. So we are going to have to put her in an apartment for the next 12 months, I'm going to take part of that 2,400 and pay her rent every month. I'm not, my tenant is, right? So I'm going to slow down my payment schedule. I control the cash flow. So that's going to go into her, but it doesn't cost me a dime. It's just cash that's flowing. So it's going to take me a little bit longer to fill up my bucket. But if I didn't, I want to get it back to that math. And that's exactly right. My policy grew 188. And at the end of 7.5 years, now I've got a free and clear, even though I never had a mortgage, I owned the mortgage. I'm the bank. So, but I paid myself back fully. And now I've got $2,400 a month that's coming in.
Yeah. And so you can use this with any purchase or any investment too. So if your daughter needs a new car, you can borrow against your money and be the Mike Schwallie Bank of America.
Yeah.
And then she can pay it back because this is her policy when you pass away, because it is a life policy, right? So 100%. That just continues to grow generationally, that wealth for your kids, your grandkids, and so on, so long as they follow that rule that once you borrow the money from yourself, you still want to pay it back at some point, right?
Yeah. And that's the only risk here involved, Jason. And we're going to, cover that, but the risk of this is what Nelson used to call you steal the peas. He wrote a book, Becoming Your Own Banker. And in that book, he talks about the grocery store owner, and everybody shops in the front door, but his family was shopping through the back door and they weren't paying full retail price. And it's a great little section of the book, and I highly recommend to read it. But what we're talking about there is if I were to borrow that money out and not pay myself back, which I'm not obligated to do, because and what I want to educate your listeners on is if I don't pay that back, I will die one day, and that loan will be paid off by my death benefit because this is permanent insurance. It doesn't go away. But that's the only risk here, is that we overextend ourselves. We take too much out. It's not really performing the way we want it to work because we've got loans outside, and we want that money to flow. We want it to go in and out, in and out. We die if our blood stops flowing. Water gets stagnant if it's not flowing. Money is the same way. We need money to flow in our lives, and the more it flows, the better we do.
Yeah, that's a great analogy.
Yeah.
Cash flow, right?
Mm-hmm.
Cash flow going into the bank, the river bank. I know I was watching this video about how they broke down how water and money, essentially you can correlate it to different ways that they talk about water versus money. So I think that's pretty cool. So, okay. So you did mention risk, right? So I know you said the only risk, and if you can just say that again. So what's the only risk of this policy? If someone goes into this policy,
not just risk, but also the hesitancies. Number one, the life insurance. If people hear life insurance and they think about their grandparents' policies, or they heard some story that's something our office, we focus on whole life insurance. The reason we focus on whole life insurance is because there's contractual guarantees built in. It cannot implode. It's going to function. What you see is what you get when if you put in X amount of premiums. Cash value, death benefit are contractually obligated to do what they show you they're going to do. So we like that. We don't want to take risk. There's other products out there that come with some risk involved that we don't even use. I wouldn't sell them to my worst enemy.
So I'm sorry, Mike. So you can still take a risk, but with that money you want to take a risk with, if you run it through the policy, you'll pick up that 5 to 6% interest or tax-free money.
Correct.
While you go into your risky asset, it's almost like a pass-through.
Yeah, I'm not telling anybody, especially a bunch of real estate investors, not to take risk, right? We take risk. I mean, but those are investments, whether it's real estate, crypto, whatever you're wanting to do with your money, go put that to work somewhere else. This is your savings vehicle, your warehouse for that capital, and do those other things. Absolutely. I have syndication deals. I own real estate. I have crypto. Those are things, those are investments. This is savings. That's a different conversation altogether. Great point. Yeah. Now, the other drawback is, and you know this, Jason, is there's a cost to do business, right? We're starting our banking system. And in the first year of these policies, depending on age and health a little bit, but primarily in the first year, 60 to 65% is liquid. So use a round number, $100,000 goes into a policy. We've got access to $65,000 year one. $35,000 is illiquid in the first year. That stinks. Nobody likes to hear that, right? But that's the cost to get into the so if it's 10,000, it's 3,500. It's all relative. So that's a drawback for a lot of people. But you are buying a permanent death benefit for your family or your spouse or a charity, whatever you want to do it for. So So we are getting that insurance benefit, and I could go on and on about all the different benefits that are inside this thing, but there's a cost to do business. So the upfront cost in that first year is somewhat scary to some people, but once we get past that, year 2, year 3, dollar for dollar, you put in 100,000, you've got access to 100,000. So after you get past year 1, you don't have that illiquidity event anymore.
Gotcha. Okay. And I know for a fact, because I've been doing this probably for 9 or 10 years now, and you've got a couple of my bigger policies. So thank you for setting me up there.
Yeah.
A couple of things. Number one, when I start a business, I don't expect to be fully liquid. If you're talking about starting a business or opening a bank, you don't expect to put $100,000 investment and then have all of that. So I think 65% is actually a pretty big number. Yeah. If you can commit to doing that. And you don't have to start that big. I didn't start that big. My first policy, I did a $5,000, investment just to see how it worked. Once I saw the compounding, and that's the other thing I wanted to mention to you. Year one is scary. Year 2, it's dollar for dollar. Year 7 and 8. So that's when you're getting more money back because of the dividends that is being paid on your policy. So if you can talk a little bit about that.
Yeah, absolutely. So I'm with you, Jason. I started small. I started with a $20,000 policy 15 years ago. That was my very first policy. I now have 7. I've got 3 on me, 2 on my wife, and 1 on each of my daughters. And we use them for a whole lot of things, infinite number of things. But you're exactly right. My first policy is my best policy, because right now, when I make a premium, it's almost tripling. It's 15 years down the road. And if I put in 10 grand, it's turning into almost 30 right now. What a great, I'm depositing 10. And as you know, a week later, I can pull that right back out at 30 and go put that money to work. So, but it didn't happen overnight. So that's right. One of the drawbacks is this is not a get rich quick scheme by any means. This is slow and steady wins the race. And so that compounding effect does take time to occur. So we always, and as you know, Jason, the first 5 years of the policy are what we call the capitalization phase. The best analogy I can give is there's a base premium on every policy, a have to number. So I'll use my policy, my very first one. My base premium was $7,200, $600 a month. I have to put that in. I know that's my required amount every year. In the first 5 years, I was able to put in an extra $12,000, almost $13,000. Those are kind of like, so my base premium is the rocket. The 5 boosters are what gets it out of space. So I could put on about 5 boosters into that policy to get as much cash as I could to get it what we call leveraged and really functioning, where I'm putting in $1 and in year 6, it's kicking off $1.25 for every dollar I put in. Year 7, I put in $1, I get $1.30. And it just gets better contractually each and every year. Now I'm putting in $1 and I'm getting $2.70 for every dollar I put in. So, but there's restrictions, and everybody asks me, well, why do you have 7 of them? Well, I earned more money over my lifetime. I needed another place to park capital. So I started another policy because my first one was capped out. We can't go over what's called the modified endowment contract line. We can't overfund these things because they become an investment, they become taxable. So we stay right up against that guideline. And that's our job. And the insurance company won't allow you to go over that line. So
yeah. And so the goal is to keep your money away from Uncle Sam by using a legal method of parking your money somewhere that's safe, number one, or if you get sued, can't be touched, right?
Yeah, that's right.
And it builds over time. It's not a get rich quick scheme. I know this because I've been in it for a while. It's really a get rich slow scheme that I like to call it. So, okay. So a lot of people may have not heard about this process and how we can actually park your money in these things and use it to benefit you over time. Can you give us any examples of, because I feel like when I first found this out, Mike, I was like, man, this is like the secret of how these 1% elitist people, how they use their money. Who do we know? Do you know anyone that maybe people can connect with, like maybe a famous person or rich person? Like who's using this product that you can give an example for our audience?
I'll give you an interesting one that the article came out about 6 months ago. The chair of the SEC. So this is the guy that oversees all investments, right? They did an article on him and they asked him where he parks money. He has 56 life insurance contracts.
Yeah.
He's been doing it his whole life. He's an older gentleman, right? But he has built, and they're not all on his life. They're on his family, his spouse, his kids, his grandkids. I mean, business partners, Me and you go into business together, Jason, we can own a policy on each other because there's an insurable interest. That's what you need to have a policy, right? So that's an example, one extreme example, but there's so many. I mean, it's a lot of the higher paid college coaches nowadays, this is how their salaries are being done. The university is loaning money into a life insurance contract to pay their salary. They get to access it for it's called the federal applicable rate, but it's like 2% tax on that money. It's a great solution for them. And then eventually those coaches will die and the universities will get a large refund of their premiums. It's a great solution. Now that's a different solution than what you're talking about on the me and you level, but business owners, they buy equipment, they buy inventory, they have reoccurring cash flows. That's all we're talking about, is creating a path through for a lot of these business owners to run money through, put it to work, and then when that money comes back in. And that's how I got into this, Jason. As you know, I owned a moving and distribution company. Yep. We had a buy-sell agreement. We had a pool of capital, and we were borrowing money on a line of credit from the bank. I learned about this through Nelson Nash, and I said, well, I'm practicing infinite banking, but I just am not using the right vehicle. And so we started at that time. My first policy way back then was on my business partner, and we started running money through. And then eventually we sold the company, and I was passionate about this concept, and I got my degrees I had a finance degree, but I got my certifications, and here I am 12 years later, still teaching this to a lot of people. So this is what makes me happy. I like this part of it. We do all things investment in our office, and there's nothing wrong with investments. We can do I believe in a three-legged stool approach, right? We got to have our safe money, our liquid capital. We got to have some investment money that's built for long-term. And then we got to have some liquid capital that's putting to work. Private money deals, real estate, crypto, whatever you're doing, your business, that's that third leg of the stool. We've got to have all three of them. This is just that savings vehicle, that bucket that we use for that leg.
Love it. So I heard Walt Disney used it to build his parks. Is that true?
That is true. Walt Disney used it to build his parks because he couldn't get a loan to build the swamp, right? And so he said, all right, I'll show you. And he started borrowing and leveraging his life insurance contract. Ray Kroc from McDonald's, they wrote a book on him. There's a documentary out there. McDonald's almost went out of business. He borrowed against life insurance to kind of ease the water for a while, and then got back in. JC Penney, Pampered Chef lady that started Pampered Chef. That's how she started, borrowing against life insurance. Yeah, there's a lot of stories out there about it. It's been around. This is not a new thing. This has been around that the uber wealthy had used for hundreds of years. Nelson just sort of discovered it. Nelson, by the way, was a real estate entrepreneur. He was a forester. He'd buy timberland, sell it off over time. You know, you want to talk about long range thinking, waiting for those saplings to grow. But that's what he would do. When the mid 80s, what happened? Interest rates went through the roof. He got caught owing the banks a lot of money every month. And so he had a brother that sold him a life insurance policy back when he was 18 years old, before he went to the military, and it grew and had cash value. And he discovered that he could borrow against it to pay off the bankers and get out of this debt. Well, that's when he went down the rabbit hole and found that policy that his brother sold him was one of those traditional old school policies that took forever to grow. He saw that you could redesign the contract for cash accumulation, not death benefit. In between you and I mean, and your listeners, the death benefit is where the cost is, right? For the insurance, that's the risk on the insurance company. What we do is essentially lower the death benefit to the IRS minimum and stuff as much cash in there as possible. So we play by the rules. Absolutely. We're not going to do anything illegal, but we want to minimize the expense to the lowest level, maximize the asset. Yep.
Right. So life insurance policies in general, this is not something you can just do without it being specially modified and built to what your specific need is or what your specific client's need is. Right. So it's not, if you just have a term life policy or just a whole life policy, this may not work for that specific insurance company. Correct. So I know for me, we had to break down exactly what the maximum I was allowed to put in, what I actually qualified, like how big of a policy I can do. And for beginners, someone who's just starting out, maybe you want to start with something small. Let's just see how it works. But, when you broke down the numbers for me, it actually took me a couple of times to do it, because this is not an easy, like, hey, we just watched this podcast with, Mike and Jason, and now I understand everything. It's really hard to kind of digest. So it took us 2 or 3 meetings before it's really started to sink in. And I think it was just kind of like this switch that came on. Say, wow, I just have to think about using money differently.
Yeah, we say it all the time. It's not taught, it's caught. And you're exactly right, Jason. If once you utilize it and you feel it and you see that your money didn't go down when you started borrowing, it's foreign from any other financial tool that we use. So it does take a little bit of transactions and getting used to it. We use it to pay off a lot of debts early on when we're kind of, you got a car payment that's costing you $500-600 a month and you owe $15,000. Well, we run money into a policy, we'll leverage it out, pay off that payment. And where does that $600 a month go? Right back to you. But now you're in control. If life throws a curveball, you have the freedom to turn that payment off if you need to. Or if life gives you a windfall, you can pay it off sooner and there's no penalty, so it's just the control factor is huge. The freedom it gives you, the peace of mind. So yeah, but it does. You're right. It takes a little bit of understanding and learning to do it.
Awesome. All right. Well, listen, Mike, I think we covered a lot of info today. And guys, if you've got value out of this, give us a like, give us a follow. But before we go, as we said, it is something that you need to know about. So what we're going to do, we're doing a book giveaway, I don't know if you could see this here, but Becoming Your Own Banker by Nelson Nash, 5th edition. This is a breakdown of how it works. We're doing a giveaway. Just comment. Let's see, what should we comment? IBC for Infinite Banking Concept. You put IBC. We're going to go give away a book, and Mike is going to do a free consultation. You can book it with him. We'll have information for how to contact Mike below. And I appreciate you being on, Mike. Do we miss anything? Is there anything else we needed to say before?
I think we covered it, but I want to even up I'll give away 5 free books. So you got 1, I'm going to add 4 more. So the first 5 people to comment, I'll get your contact info and we'll send it out to you. We've also, and I'll share, we've got podcasts, we've got videos, we've got different resources. If you're not a big reader, there's other ways to consume content. So no, Jason, I think we covered it. I really appreciate the opportunity, my friend.
No, it's my pleasure, guys. So if you want to act like the 1%, if you want to be the Walt Disneys and the Ray Krocs of the world, if you want to know the secrets of how the wealthy stay wealthy, this is it. Mike, thanks again for being on, man.
You got it, buddy. Thanks.
Take care, everybody.
Today's episode of Beyond the Guidelines comes to a close, but the story doesn't end here. If you enjoyed this conversation, make sure to subscribe so you never miss the next one. And if you'd like to share your own story on the show, check out the link in the description to connect with us. Until next time, keep rewriting the rules and remember to go beyond the guidelines.